Chesapeake Utilities, trading on the New York Stock Exchange under the ticker CPK, just missed Wall Street's second quarter 2026 consensus.
Right. They reported GAAP and adjusted earnings per share of $1.05 for the quarter.
And that misses the $1.09 consensus estimate by roughly 3.67%.
It does, though, it is a slight increase from the $1.02 they reported in the exact same quarter a year ago.
Yeah, true. Revenue came in at $201.9 million. So that's a 4.7% increase year over year.
But still slightly below the $202.54 million forecast that analysts had, penciled in.
Exactly. But honestly, the actual headline here, the thing completely overshadowing the top and bottom line miss, is the guidance.
Oh, absolutely. Management just raised their 2026 capital expenditure guidance by a full $100 million.
Which brings it to a range of $550 million to $600 million.
Yes. And crucially, their 5-year capital plan, so covering 2024 to 2028, just ballooned.
Right. It went from a midpoint of about $1.65 billion all the way up to over $2.2 billion.
Which is a massive jump. Yet, despite all of this new spending, they somehow reaffirmed their 2028 EPS guidance of $7.75 to $8.
And looking at the stock reaction, the market is completely ignoring the slight earnings miss.
Yeah, the stock stayed flat in after hours, trading around $133.50, and it's currently sitting at $133.85, which is up, a very modest 0.26%.
Investors are clearly looking right past the immediate quarter because this company is undergoing a historic capital pivot.
They really are.
So we're doing a deep dive into this Q2 earnings report for you to understand exactly how a top and bottom line miss is basically being dismissed by the market.
Right, dismissed in favor of this massive fundamental transformation of the company's long-term growth profile.
Exactly. So let's look under the hood of these numbers to see what is actually happening. Because looking at the revenue, this certainly wasn't, a structural collapse of the business.
No, not at all. If you look at the adjusted gross margin, which is the actual money left over after the direct cost of goods sold, it grew. It was up by $7.4 million, hitting $150.2 million for the quarter. So that's a 5.2% increase.
And when you break that down by segment, the core regulated energy segment revenue grew to $164.3 million.
Which is up from $151.8 million a year ago.
Yeah. And the unregulated segment dipped just slightly, right? Coming in at $45.2 million compared to $47.9 million last year.
Exactly.
Wait, I actually need to pause right here because I'm looking at the numbers and I'm genuinely confused by a contradiction in the management commentary.
Oh, what caught your eye?
So, on the earnings call, leadership explicitly touted that their operational expenses represented 45% of gross margin in the first half of the year.
Right, they highlighted that as being the lowest level to date.
Yeah. So if they are running leaner and more efficiently than ever before on a margin basis, how are they still missing the bottom line earnings per share expectations?
Well, it's a valid question.
Like, where exactly is the money going?
That is the perfect question, really.
Yeah.
And it comes down to the difference between absolute dollars and percentage margins.
Okay, break that down for me.
Sure, so it's that, combined with the mechanical math of equity dilution. You are right. Operating at a 45% O&M to margin ratio is a really solid operational achievement.
Yeah, it means they're running the day-to-day business efficiently.
Exactly. But when a utility is in a high growth phase, the fixed costs of financing that growth act as a massive drag.
The financing costs.
Yeah. First, look at the absolute dollars of debt. The interest charges rose to $18.4 million for the quarter.
Which is up from $17.8 million.
Yes. And depreciation and amortization on their new physical assets ticked up to $22.9 million.
So the fixed costs of just carrying the infrastructure are rising faster than the immediate cash it actually generates.
Spot on.
And then there's the share dilution you mentioned. The company increased its share count by about 600,000 shares recently.
Right, and they did this via a few different avenues. Their DRIP, which is their dividend reinvestment plan, their direct stock purchase plans, and their ATM programs.
And an ATM program, just for those following along, is an at-the-market program. That's when a company slowly trickles new shares into the open market to raise cash incrementally.
Right, rather than doing one giant disruptive stock offering that tanks the price.
Exactly. So it feels like we basically baked a slightly larger pizza this quarter because net income actually grew by 6.3% to $25.4 million.
Yeah, it did.
But because of those 600,000 new shares, suddenly a lot more people showed up to the party to grab a slice.
That is the exact dynamic at play here. You have a larger financial pie, but you are forced to cut it into significantly more slices just to fund your operations.
So everybody's individual slice, the earnings per share, gets compressed.
Precisely. And this is the inherent friction of utility growth. They generated an incremental $10 million of margin from growth in their transmission and distribution systems this quarter.
But they had to issue shares to fund the construction of those systems in the first place.
Right. The cost of the ingredients to bake that larger pizza simply went up.
That need for cash and the reason for those 600,000 extra shares brings us directly to the reason the capital expenditure guidance just skyrocketed by hundreds of millions of dollars.
Yeah, Chesapeake Utilities is taking on a staggering new infrastructure project.
Right. They officially announced the Florida Energy Pathway, or FEP, project alongside these earnings.
This is a $1.2 billion natural gas pipeline project located in South Florida.
Wow. $1.2 billion.
Yep. It features approximately 250,000 decatherms per day of committed capacity, and they are targeting an in-service date of 2030.
Okay, to give some scale to that jargon for you, a single decatherm is roughly equivalent to 1,000 cubic feet of natural gas.
Or about 1 million BTUs of energy, right?
Exactly. So 250,000 decatherms per day is a massive volume of energy flowing into South Florida.
Oh, huge. It's meant to support the rapid population growth and industrial demand down there.
But I have to push back on this strategy for a moment. We're talking about a $1.2 billion project for a company that only has a total market capitalization of around $3.2 billion.
Right. It's a massive percentage of their overall value.
That is an enormous bet. I mean, they're essentially transitioning from a steady, predictable, regional regulated utility into a mega project developer.
It's a big shift, definitely.
Doesn't that radically alter the risk profile for the retail investor? Especially the one who bought this stock specifically because they wanted a low volatility, reliable utility dividend.
It definitely shifts the risk profile, yeah.
Yeah.
But in the utility sector, we have to remember that stagnation is often the bigger risk.
Really? How so?
Well, utility investors do look for low volatility and reliable payouts, sure. And yes, taking on a single project that equals more than a third of your entire market cap introduces intense execution risk.
Let alone permitting hurdles and financing challenges over a 4-year horizon.
Exactly. However, the mechanism for how utilities grow their profits is entirely dependent on growing their rate base.
Right, the rate base.
Yeah, the rate base is the total value of the physical assets. The pipes, the compressor stations, the grid. It's what regulators allow them to earn a guaranteed percentage of profit on.
So a $1.2 billion pipeline, once it is completely built and officially approved by regulators in 2030.
Represents a colossal, permanent addition to their rate base.
I see. It essentially locks in guaranteed regulated earnings for decades into the future.
That's the payoff. But to get to 2030, Chesapeake has to survive the capital intensity of actually building the thing.
Right, which brings us to the core business segments carrying the load today. To understand how they plan to fund a $1.2 billion pipeline over the next 4 years, we really have to look at their current cash flow.
Definitely. On the regulated side of the business, adjusted gross margin was $124.7 million, up 6%.
Okay, that's all.
Yeah. They saw about $4.9 million in immediate margin contribution from recent transmission expansions.
And plus another $3.2 million from regulated infrastructure programs, right?
Yes. The specific programs they cited were the Florida Guard program and the FCG SAFE program.
Okay, instead of just listing off those acronyms, we need to look at what those programs fundamentally do, because it explains why they are so profitable.
Go for it.
So Florida Guard, for instance, is all about physically hardening the existing energy grid against severe weather and hurricanes.
Right, which is crucial in Florida.
Exactly. And regulatorily speaking, that is brilliant for a utility.
Yeah.
It is an undeniable, necessary safety upgrade for the state.
Yeah, no one is going to argue against hurricane-proofing the grid.
Right. So because it is deemed critical for public safety, the state's Public Service Commission allows the utility to pass those infrastructure costs onto the consumer safely and reliably.
Which guarantees a return for the company while making the grid more resilient.
Exactly. It is a win for both the state's infrastructure and the company's balance sheet.
And if we look at the unregulated side of the house, which generated $25.4 million in adjusted gross margin, up 2%, we see a similar steady performance.
What were the drivers there?
The bright spots there were increased profit margins in their propane business and solid performance from Aspire Energy.
Oh, right. Aspire Energy saw increased gathering fees.
Yes, and gathering in the natural gas industry simply means the pipeline infrastructure that collects raw gas from various individual wells and funnels it to a central processing plant.
Got it. And those gains were strong enough to offset the temporary decreases they experienced in their CNG, RNG, and LNG services, right?
Yeah, which are compressed, renewable, and liquefied natural gas. The margins on those specific fuels dipped slightly due to broader market pricing dynamics.
But the overall unregulated segment held its ground.
It did. And that built-in stability is crucial because there is a massive timing mismatch hidden in this earnings report.
Oh, this is the part that basically explains everything about how the stock is currently trading.
It really does. CEO Jeff Householder noted a detail on the call that changes the math completely.
Yeah, he said approximately 20 to 30% of the capital investments made in 2026 will not actually drive any margin growth until 2027 or later. Which begs the question, why is there a multi-year delay between a company spending hundreds of millions of dollars and actually seeing a return on that investment?
This is the fundamental mechanic of the regulatory lag. And it's really the key to understanding utility investing in general.
Okay, let's unpack that for the listener.
So unlike a tech company that can, launch a new software feature and charge for it the very next day, a utility operates under strict government oversight.
Right.
Chesapeake has to spend shareholder capital today to put the steel in the ground, upgrade the grids, or build out this Florida energy pathway.
But they cannot legally raise customer rates to pay for that new infrastructure immediately.
Exactly. First, they spend the money. Then they have to file a formal rate case with the Public Service Commission.
Which means they have to open their books, undergo public hearings, all that stuff.
Yes, and mathematically prove that the $1.2 billion investment was prudent, necessary, and executed efficiently.
And only after the regulators agree, which, let's be honest, can take a year or more, are they allowed to adjust consumer rates to finally earn a return on that initial capital.
That's the regulatory lag.
So if you are holding this stock right now, you are footing the bill today through share dilution and heavier debt loads for profit growth that you are not going to see on an income statement for another 1 to 2 years.
Yep. That requires immense patience. It creates a highly pronounced drag on the balance sheet during a heavy construction phase.
So the cash is flying out the door right now in 2024 and 2025.
But the corresponding earnings bump is legally delayed by the regulatory bureaucracy until 2027 and beyond.
Wow. Well, that built-in delay perfectly explains why Wall Street seems to be looking right past today's Q2 miss and staring directly at the horizon.
Absolutely. Management is calling this current phase a transforming period for sustained enterprise growth.
But they are notably holding off on giving Wall Street a comprehensive 2027 to 2031 earnings and capital expenditure update until February of 2027.
Which is a long time to wait.
Yeah, why wait so long to give the market the long-term math?
Because of the sheer size of the Florida energy pathway. Householder and the management team explicitly stated they want to have a much clearer picture of potential equity partners for the pipeline project.
Before locking in long-term forecasts.
Exactly. When you are a $3.2 billion company trying to build a $1.2 billion pipeline, bringing in a joint venture partner to shoulder half the cost drastically changes everything.
It changes your future debt load, your future earnings profile, all of it.
Yeah, they need to lock down the funding mix before they make promises to analysts.
Makes sense. But the risks to hitting those future targets are very real. And the company is explicitly calling them out in their filings.
Oh, for sure. In their 10K update, they flag the standard execution, permitting, and financing risks of building a massive pipeline.
Right, but they also explicitly highlight two very modern macro risks.
Yeah, the geopolitical trade policy uncertainty and the escalating threat of AI-driven cyber attacks.
Let's unpack the mechanisms behind these. Because at first glance, why does a domestic natural gas pipeline in South Florida care about global geopolitical tariffs?
Right. It seems disconnected, but it's because a pipeline of this magnitude requires an immense amount of specialized physical materials.
Like what?
Particularly high-grade specialty steel. You need it for the pipes, the industrial valves, the compressor stations, and a lot of those components are integrated into global supply chains.
Okay. So if trade policies shift suddenly or aggressive tariffs are placed on imported industrial metals.
The input costs for the Florida energy pathway could spike overnight.
Wow. So a project budgeted for $1.2 billion could easily become much more expensive purely based on international trade disputes.
Exactly. Disputes that are completely outside of Chesapeake's control. And obviously, we're just imparting what's written in their 10K here. We aren't taking any stance on the politics of trade policy.
Right, absolutely. We're just looking at how the filing flags the potential cost impacts for the project.
Exactly.
And the cyber threat is equally tangible. When we talk about AI-driven cyber attacks on a utility, we aren't talking about someone hacking a customer service email account to steal passwords.
No, not at all. We are talking about the difference between IT, which is information technology, and OT, which is operational technology.
Right. Utilities run massive OT networks.
Yeah, these are the digital systems that physically open and close pipeline valves, monitor pressure, and route energy across the state.
And as artificial intelligence techniques evolve, they basically allow bad actors to automate highly sophisticated probes into these operational networks.
It's terrifying, honestly. Defending a modern pipeline isn't just about putting a physical fence around a compressor station anymore.
No, it is about defending the digital architecture that controls the physical steel.
And the cost to constantly upgrade that cybersecurity defense, plus the potential financial and physical liability if a breach occurs, are massive.
These are escalating risk factors that analysts are being forced to actually model into their valuations.
They have to.
Speaking of those analysts modeling this out, where does the sentiment on Wall Street stand right now regarding CPK?
Well, the consensus across the board remains a firm hold.
Just a hold, huh?
Yeah, because of that regulatory lag we discussed and the pending search for a project partner, analysts are largely sitting on the sidelines.
They're waiting for that February 2027 update.
Exactly, to get absolute clarity on the funding mix. The average price target is currently sitting around 137 up A.
Okay, so given the stock is trading just under $134, they are forecasting a very slim upside.
Yeah, less than 3%. Wall Street is essentially in show-me mode.
They want to see management execute on the early stages of this pipeline before they upgrade the stock,
Precise.
which raises a critical question for the everyday retail investor holding this stock for the yield.
Oh, the dividend question.
Right. CPK has historically been viewed as a great, reliable dividend stock. But with analysts screaming hold, the stock trading mostly flat, and a massive $1.2 billion execution risk on the table.
Is it a trap?
Yeah. Is CPK currently a dividend trap for retail income investors? Or is this just a rare opportunity to get in on the ground floor of massive, multi-decade utility growth?
Well, classifying a stock in transition is always difficult. But we need to define what a dividend trap actually is first.
Okay, how would you define it?
A dividend trap usually implies a company whose underlying business fundamentals are deteriorating, meaning the company is secretly hollow and the actual dividend payout is at severe risk of being cut just to save cash.
And that is not what the data shows here, right?
No, not at all. The underlying regulated business is very healthy. Year-to-date adjusted earnings per share are actually up 8%.
So the core engine is running just fine.
It is. The pressure is entirely self-imposed by their ambition.
Exactly. The issue is purely capital intensity.
Yes. They are actively choosing to issue new equity, which dilutes current shareholders today, to fund a massive future expansion.
So it is not a trap, but it is a fundamental pivot in the investment thesis.
Absolutely. For a retail investor, this specific earnings report proves that CPK is transforming. It's going from a simple, sleepy yield play into a complex, multi-year growth and execution story.
You basically have to be completely willing to stomach the near-term share dilution and the heavy debt loads today in order to capture that massive rate-based expansion promised by the Florida pipeline in 2030.
You really do.
Let's bring this all together for you. Chesapeake Utilities delivered a slight Q2 earnings miss, but that miss is ultimately just a minor footnote to a massive strategic pivot.
Right.
The company is actively trading near-term share dilution and heavy capital costs today for massive long-term rate-based expansion via the $1.2 billion Florida Energy Pathway project.
And their core regulated business remains healthy and is actively generating cash.
But the built-in regulatory lag, that timing mismatch between spending $1 billion today and legally earning a regulated return on it years from now, is going to require immense patience from anyone holding the stock over the next few years.
It's true. The company is laying the physical and financial groundwork right now for the next decade of their business.
Yeah.
But the transition period over the next 4 years will be highly capital intensive. It's going to be heavily reliant on debt and equity financing and very closely scrutinized by the market.
Essentially, every single earnings call between now and 2030 is going to be graded as a progress report on that pipeline.
Without a doubt.
Before we wrap up, I want to leave you with a final lingering thought to mull over regarding those macroeconomic risks we just explored.
It's a big one.
If global geopolitical tariffs on specialty steel continue to escalate, and the required costs of defending operational technology against AI-driven cyber threats keep rising, could this $1.2 billion price tag for the Florida pipeline just be the starting bid.
Oh, that's entirely possible.
Think about it. How much of a multi-million-dollar cost overrun can a regional utility actually absorb before the underlying math fundamentally breaks for the retail investor footing the bill?
Definitely something to watch closely.
Think about that. And as always, make sure to follow the show for your daily earnings coverage.